Thank you, Serge. And if you have followed international press recently, you might have observed actually private credit being featured in some unsettling headlines, actually, right? Some actually also talking about the spillover effect onto Europe, but they're predominantly in the US. And what I would like to offer you today, ladies and gentlemen, is a perspective to this and invite you to dive with me a bit under the surface. But before we do that, I actually would like to talk a bit about private credit and its success story, right? Private credit, so the non-bank lending to corporates, has grown and tripled over the last decade to now $2 trillion globally. It has delivered consistent returns, it has actually shown resilience over credit and stress cycles, and it actually has seen sustained institutional growth. Now, obviously, Luxembourg in this context has emerged as, I should probably say, the natural hub for private credit in Europe, as well for the wider private markets ecosystem. But let's have a quick look at what is the context of these headlines. And I would like to start by saying, after years of institutional dominance in the US, some managers actually some years ago have started offering access to retail investors into what is called evergreen or semi-liquid structures. And these structures, they feature optionality in terms of liquidity, usually on a quarterly basis, capped to 5%. And this cap is not a flaw, right? It's actually meaningful because it protects remaining shareholders in a fund from fire sales, and with that, obviously, deteriorating portfolio values. But when especially retail investor expectations diverge from fund mechanics, friction can follow, and so can headlines like the ones we see on liquidity squeezes or sloppy underwriting. But that taken into context, what are then actually the main three challenges that private credit faces right now? Number one, certainly AI in software. So about 20% of global credit and private credit assets are in software borrowing firms. And AI is not only shaping our entire industry, and our society even, it's also shaping and reshaping that sector. There's a risk for some, no doubt about that, but it also is a real opportunity for a lot of players and corporates in that sector. The next challenge is also retail redemptions. If you think about it, investors actually in these type of strategies, and now looking at the US, right, they invested into something illiquid. And now retail basically wants to get out in the US. They basically face those challenges. And that is also what hits the headlines. And we also have the challenge in terms of underwriting scrutiny. So the discipline when it comes to underwriting credit is actually put to test, because when there is strong inflows and fundraising, actually also capital needs to be deployed immediately, ladies and gentlemen. That can sometimes also put credit standards under pressure. But as I said before, let's look a bit below the surface. And maybe we can say the fundamentals of private credit are still strong, right? Default rates are still low to mid-single digits. Returns actually have been consistently strong, 8 to 10% annually. And there's actually a case for Europe in all this, because European credit actually, or typically I should say, caters for higher interest rate coverage, lower leverage, as well as stronger covenant protection versus its US peers. So ladies and gentlemen, what matters now? To my opinion, I actually think that the stress that we see in the US, it's growing pain, not at all a terminal illness. And that also means that managers navigating that environment, they can probably look at 4 factors. Number one being, it's about knowing your customer. Not in an AML context, but it's also worth knowing your customer in this context. Why so? Because private credit is inherently illiquid. It's illiquid by nature, right? And that actually means also that it shouldn't be sold for anything otherwise, especially not as the retail access is widening. So clear investor communication and the support by their advisors is paramount. The next thing is also communicating plainly. It's not about more marketing. It's about being clear as to how, for example, your liquidity caps are working. It's to be clear about how you invest. This is really an edge for managers. It's actually disciplined underwriting. Clear credit standards applied consistently, they actually benefit managers not only today, but throughout their life. But in times like these of dislocation, they come to the forefront. And last but not least, it's also about valuing experience. Cycle-tested managers with long team tenure, they have been in these places, and they probably have the stamina and the expertise to weather these situations once again. So ladies and gentlemen, let me just offer you a conclusion. To my opinion, I actually think the business case for private credit ain't broken at all. Not at all. It is rather that what we see in the US is probably more a mismatch between what you could call investor expectation, predominantly on the retail side, versus how funds and the mechanics and the features do work. For us, what we can learn from it in Europe is actually we shouldn't fear the asset class at all. To the contrary, ladies and gentlemen, I actually think we should, however, embed clear customer communication. We also should be very honest about how we educate, especially the retail investor, and also be clear about our credit underwriting standards in the way we design and distribute our products. So in one sentence, private credit is not melting down. It's maturing. Thank you.